As I said, it's a pleasure and an honor to introduce you to Mr. Craig Phillips. Good. Well, thank you. Thank you very much. It's a pleasure to be here today. And I've looked over the agenda. You've got some great speakers, great content, so I really hope it's a rewarding visit to Washington. I really want to share our vision for the economy, for the appropriate tailoring of regulation, and really the importance of making cost-effective credit available to consumers and businesses, something I know all of you are involved in. You know, online lending, broadly defined, to me presents an exciting new choice for the delivery of a wide range of credit products. All of you address that in some form or fashion. And it speaks to several key themes driving our policy, which is the importance of American leadership in technology, because first and foremost, it's a technological innovation. Secondly, the strength of our public and private capital markets to support the formation and organization of a tremendous number of companies, new companies in many cases, and the importance of innovation writ large, which to me is the topic of our last report. And I also want to applaud each of you for taking the time to come to Washington and work on policy. Policy is always important, but it's particularly important in our view at this juncture in the evolution of online lending platforms and the relationship to the banking and mature financial system that we enjoy in the U.S. So for me, it was great timing with Jessica and others to participate in this conference and also showcase our most recent report, which I'll refer to as the Fintech report. So the administration is committed to really an economic agenda that creates opportunities for everyone and to make our businesses more competitive and create the right jobs and wages for American workers is our number 1, 2, and 3 priorities. But to do that, we need an effective and efficient regulatory system. So we are working on and will continue to work on the identifications of regulations that can be updated, changed, and better tailored, and also regulatory reform that better fits the world in which we live. So we've identified hundreds of recommendations to date in our 4 reports, all of which are in motion. Some require congressional approval, some are regulatory in nature, and some, and the FinTech are really new ground. So what was really exciting about working on this report was that some of this area is just, not defined. So things that are defined incorrectly, because as in the past, there's things that are maybe too structured, but there's a lot of open space in this area, and we found that really exciting to kind of paint a vision of data, technology, and how it can help the U.S. economy. So many of you are familiar with the fact that President Trump in February 2017 wrote the executive order that set out the principles, the core principles for the financial system. So all these reports grew out of that executive order. And the core principles are really basic values that I think resonate with what many of you are doing. One is empowering Americans to make independent financial decisions and informed choices. Many of you provide sort of a platform to consumers or businesses to approach that you probably feel is somewhat different than the experience they would have with a traditional bank. We want to protect taxpayers and prevent taxpayer-funded bailouts. Few of you, if any, are using deposits, so you really are achieving that goal. We want to foster economic growth through vibrant financial markets with rigorous regulatory impact analysis. That means really studying the impact of regulation before you pass it, make sure the cost-benefit analysis is there, make sure that our companies are competitive with foreign firms and American interests are represented well in the standard-setting bodies. I think this industry speaks particularly to that because if we don't get certain elements of regulation right, the jobs inherent in your industry will go overseas. We want to make regulation efficient, effective, and appropriately tailored. And we want to restore public accountability within the regulatory agencies and also rationalize the regulatory framework. So all of these factors, I think, in the core principle that, was the prism through which we looked at the financial system are particularly true of the online lending and FinTech in general. So given the huge breadth of the system, we decided to break our work into 4 reports. The first covered banks and credit unions, the second capital markets, and the third asset management and insurance. And the 4th and final report on FinTech, which we released in July, covered not just financial technology and innovation, but also non-bank financials. And I'll mention in a moment that there was, since the financial crisis, a powerful trend of business leaving the banking system to the non-bank sector, and that was a very important topic to cover. So just briefly, the takeaways from all the reports are similar in that we have changes to both statute and regulation. Some require congressional approval. Many can be done by the regulators. In this space, we have the complexity of a complex relationship between federal and state regulation to deal with, but those factors are true here. Second, we really have to reduce regulatory overlap, fragmentation, and duplication. I mean, if everyone could just do the regulatory procedure once, it would probably be the single biggest improvement to the financial system that would be possible, but that's actually easier said than done. So we're really focused in on that across our reports. Third, we want to better tailor regulations based on size and complexity of an entity. While we had some thresholds, in general, we favored a risk-based approach to regulation and also a common sense approach to regulation. If the regulator is trying to cover too many prescriptive items, it's really hard to have enough resources to do that well, and some of those items are less material than others. And lastly, we really truly believe that improving credit flows to consumers and businesses can improve the economy, and that you can actually achieve that goal while maintaining strong safety and soundness standards. Credit is plentiful, but it's not uniformly available or available in the best possible terms to all borrowers, and we think that can be improved if regulations are better calibrated. Far too many qualified consumers, especially home buyers, still find it too difficult to get a loan. And this is in part due to regulatory burden and undue complexity, which in addition to slowing down the availability of credit and the process also increases the cost. So really the cost of credit also is a really important consideration in looking at regulatory burden. So as I mentioned, the triage of reports and our thought process of why we decided to do the Fintech report. So throughout the work on the other reports, innovation and technology was a theme, but we didn't grapple with it. But there were several themes why we did the last report. One was we consistently heard that innovation was of critical importance, and in many ways it's driven by new technologies, the use of data, the cloud, machine learning, artificial intelligence, and concepts that outside the regulated world are exploding, but have an uneven relationship and application in the regulated world. So we really thought that if you look at the increasing reliance in consumers and businesses on mobile applications, that the nature of how technology is deployed to borrowers and other financial consumers of financial services was critical. So regulators, we determined, need to participate in public and private effort to better understand the drivers of these changes. So we really wanted to explore that major theme of innovation and the change of the regulatory climate in the report. We also found that regulations that arose as a consequence of the financial crisis, and particularly those required by Dodd-Frank, resulted in large segments of financial services migrating from the banking system to non-bank financials. So we wanted to explore that trend, and many of our activity-based regulations really are speaking to that of sort of services provided by non-banks in general, many of which would have been exclusively provided by banks prior to the financial crisis. And finally, a large amount of the innovation is occurring at fintechs. We define that as independent companies providing some element of products, services, or technologies relevant to the financial services sectors. That's a pretty broad definition. This is an online lending-focused conference. There's a lot of different types of fintechs. And how we license and regulate these companies is an important topic that we must explore. So while we are very supportive of the expansion of smaller companies, startups, new entrants, we think it's really critical that we define the right form of partnerships of those companies with banks, insurance companies, and asset managers to really achieve the economies of scale and innovation. So a lot of our report dealt with not just the aspect of fintechs and their sort of explosive growth and expansion, but also the critical nature of allowing the right interaction and partnership or vendor arrangements with mature, larger financial institutions. So for all those reasons, doing the report became a high priority. To give you some top-level context, I don't need to tell you this, advances in technology are unfolding at an accelerating rate. The real key is how can we duplicate the potential of that rate of growth in the financial services sector that you see in other sectors. Secondly, there's an incredible opportunity but also responsibility with the use of data. The digitization of finance combined with the increased connectivity I mentioned creates a unique opportunity to revolutionize the delivery system for financial services. And third, there's a tremendous amount of investment capital available to drive growth in this technology. This reflects capital for startups and also lending capacity, but the involvement of telecom, internet, social media providers, and other data vendors are a group of companies that are very U.S. led around the world, but also are some of the largest capped companies in the world. So we have a wall of capital willing and able to invest in this sector, which is a tremendous opportunity for the economy. So since the financial crisis, the landscape has changed substantially. So from 2010 to 2017, at least 3,300 new fintech companies have been founded, approximately 40% of which by our data are focused on banking and capital markets considerations. Fintech financing has grown rapidly, reaching $22 billion globally in 2017, which is a 13-fold increase since 2010. And in particular, marketplace lending now makes up over 24% of all U.S. personal loans, roughly $18 billion worth, nearly tripling from 2014 to 2015 alone. Another interesting piece of data that we quote is that in 2012, it's estimated that 90% of the digitized data in the world had been generated in just the prior 2 years, a fact that has incredibly large significance for delivery of financial services. So in short, the use of the data, the speed of communication, the proliferation of mobile devices and applications, and the democratization of information flow have all broken down barriers to entry for a wide range of non-traditional providers, many of which I'm sure are here. But it's also an opportunity for mature financial institutions to learn from you, to partner with you, to have a vendor relationship to broaden the nature and characteristics of their services. So the reason to us marketplace lending is important is that the consumers and businesses' needs are changing. Interest in digital connectivity naturally serves to decrease the relevance of bricks and mortar footprints, and mature companies with this infrastructure are increasingly challenged to access and source customers through electronic means. Marketplace lenders are also important because their versatility in addressing a wide range of credit needs. There's a lot of different platforms. Many of them focus on a single asset class or even a part of an asset class, but across unsecured consumer, small dollar consumer loans, the refinancing of student loans, small business loans, auto finance, and residential mortgage credit, there's initiatives that appear to us to be very transformational for the customers. We also think that there's strong early indication that these lending channels provide opportunities to expand credit to underserved markets. You don't need to live near a branch to have a face-to-face engagement to access the services. New data techniques may be expanding through traditional credit boxes using innovative new approaches. And while branding is important, attracting and retaining clients, particularly younger clients, may well be more effective through the online venues than the mature bricks and mortar branches. We've been doing a lot of work with the other regulators on the Community Reinvestment Act. I know Greta Gardner earlier spoke about her vision of the charter and sort of the social responsibility comes with investing in communities. But all of the indications that we have seen is whether there is or isn't a compliance procedure for the Community Reinvestment Act, that actually these platforms are actually increasing access to credit and actually bringing people into the system and effectively serving underserved borrowers and other consumers of services. The direct distribution model and the bank partnership model, both we think has a lot of merit. We want to promote the innovation in startups, but also have these versatile arrangements benefit the banking system. There is evidence that the lower cost of delivery gets passed on to consumers, so cost of credit and other services can be lower. And finally, we've outlined a regulatory approach at the federal state level that we think can promote the safe expansion of lending. So be it regulation and supervision at the federal state level, consumer protection, enforcement of anti-money laundering statutes, or access to safe and sound securitization markets, we believe that all the regulatory boundaries can help envelope the activities of fintech companies successfully. So we think it's a segment that's here to stay. It's also a segment that can advance innovation in our most mature sectors of banking, insurance, and asset management. So just to touch briefly on a few of the high-level findings, and then I'm really glad to answer a few questions. First of all, we focused on how to make better use of data in general, particularly consumer financial data. And we advocate for a regulatory approach that embraces the efficient use of that data with competitive technologies. We need to allow consumers to better understand how their data is used and have appropriate controls and protections, and then we believe that will improve the quality and terms of their services. We dealt quite a bit with the concept of data aggregation, data sharing, and all the implications. That has implications for cloud computing, machine learning, and other sort of abilities to extract insights from the data sets. And digital communication should be facilitated, which may involve modernization of certain regulatory elements, such as the Telephone Consumer Protection Act, which was designed in a totally different era and has elements that are no longer appropriate to manage the regulation of a data environment that we currently live with. At the same time, we have to use these experiences and efficiencies responsibly. So we are for adopting appropriate consumer protections, understandable disclosure, and a better accessible means to manage and revoke authorizations for data. We also have recommended strongly that Congress enact a federal data security breach and notification law to protect consumers and notify them of a breach in a timely manner. We believe that there's really bipartisan support for this effort, and that would be one major building block of the future of your industry. We also think that we need to remove legal and regulatory uncertainty concerning the interaction of financial service companies and data aggregators. While this has advanced very quickly, there still are some uncertainties concerning liabilities and responsibilities and the interchange between data aggregators and financial institutions. And as it's one of the big explainers of sort of how services and costs can be accelerated and improved, we think that clarification would go a long way. We talked about the method of accessing data, moving beyond screenscaping to API and other methods, and that all these changes should address the consistency of security, liability, and standardization. The second topic is combating regulatory fragmentation and overlap. We've made several recommendations. We think there's a place for the federal level. We think there's a place for the state level. But what's really critical is to avoid unnecessary fragmentation and overlap. I know you heard from the OCC earlier, but we strongly endorse them moving ahead with their special purpose national bank charter. We don't think it weakens regulation. We think it's a format to operate on a national basis effectively. We think can also unfold in concert with appropriate state level interaction. So we look forward to seeing the rollout of their application process. I think Gravetta described it really clearly today, and we're anxious to see that move forward. At the same time, we've really talked about support for innovation in general and how the states harmonize. So there's a number of initiatives across the states for Envision 2020 of harmonization, better coordination, better alignment of exams and principles. Those two are important initiatives, but this all has to come together in some coherent fashion, we hope, on an expedited basis. We've also talked about ways the federal regulators can facilitate bank and fintech partnerships. Some relates to vendor management considerations, some relates to the Bank Holding Company Act. There's other statutes that really sort of regulate how a bank can invest or partner with a smaller company or a vendor, or how the vendor management aspect works. So I think we laid out a vision in the paper that accelerating and clarifying those trends will be positive for the customers served by financial institutions. So overall, I'd say the regulatory approach is to balance several things, enable efficient regulations, allow for sufficient flexibility to allow for a diverse mix of firms to flourish. We want to recognize the benefits of federal and state-based approaches. And most importantly, we advocate for an approach that creates a level playing field for firms providing comparable services. There's about an 84-page section in the book that deals with a wide range of activity-based regulation. As I mentioned earlier, many of these relate to non-banks, traditional companies, not fintechs. Some relate to both non-bank companies and fintechs, and they covered a very wide range of asset classes and sort of financial situations. To cover just a few, we are very supportive of enabling the testing of newer credit models and data sources by non-banks to expand access to credit and improve the quality of risk decisions. We strongly support Congress codifying the valid when made doctrine and the role the bank as true lender of loans it makes to better support productive partnerships between banks and newer technology-based companies. We truly believe that there is bipartisan support for this in Congress. We need to try to work on that to achieve that goal. It's a very high priority. We think that further digitizing the mortgage experience can really truly improve cost and access, and we comment on notarization, digital promissory notes, and other aspects of automation that are really critical. We're very happy with that section, work closely with HUD and the GSEs and the FHFA in developing those views. We think they're very doable. We've had constructive meetings with the Federal Home Loan Bank System, for instance, on some of the things that they could do to enhance the quicker acceptance of electronic form of lending. At home in Treasury, we have the IRS. It's 80,000 of our 98,000 employees in the IRS, and one thing we pointed to was them improving their income verification system to develop a modern technology-driven interface to allow lenders and consumers to direct data sharing of the IRS data to facilitate credit decisions. This is relative to consumers, but also small businesses. And finally, payments is really critical, a faster retail payment system. So we were very excited to see the Federal Reserve last week roll out a request for comment, building on the payment task force to really study their potential role in facilitating modernization, updating of payment systems. We think that's critical. We think it can benefit bank and non-bank companies if they were to sort of build those rails. So overall, I'd encourage everyone to look at these deeper activity-based. There's too many to mention, but we really tried to go through key elements of the economy and credit provision that we thought there was room for actions and recommendations. And finally, the topic of regulatory sandboxes. I mean, really the bottom line here is that to innovate, you have to really take the first move. And there's really kind of three phases of it. Is one, having an idea that is worth experimenting with, or being a topic in a regulatory sandbox. The second aspect is getting the various regulators that might interact with that institution to agree to that form of experimentation and let it unfold. And the third is making the enhancement that has then presumably passed the test phase become permanent and allowing all companies that operate in that space to really take advantage of it. In a traditional sense, there's things like no action letters. We know that this, that getting at sort of how you do those three steps is challenging. And many of the best ideas are very proprietary, so how you actually experiment with them and make them public is a significant question. So we really pointed in our report the importance of this. So it's just our basic point is that if you don't encourage this, you're missing the whole point. There has to be a framework for sandbox and regulatory cooperation to promote innovation. We pointed to the international examples, and there's a tremendous number of countries that have successfully established innovation facilitators and to great success. So meeting with several companies that operate around the world, I'd say that our current approach is not competitive with standards that have been set around the world. So while we don't want to copy necessarily foreign jurisdictions, I think there's a lesson learned that while we might have a more complex regulatory system, a more fragmented system, that means we have to try even harder to accomplish this goal. And it might be harder for us in the U.S. to accomplish it, but it's critical. So we roll out a few key principles for this. One is, promoting the adoption and growth of innovation in financial services. That has to be the objective. So you really have to go into the concept of wanting that to be the goal. Providing equal access to companies at various stages of the business life cycle to the experimentation is critical. We don't think this is just a small company thing. Big companies should be able to do it. We need to delineate clear and public processes and procedure. That becomes challenging with proprietary ideas, but it's very important there's a framework. We really want to achieve international regulatory cooperation. Many companies operate globally. You just can't look at this within the U.S. system. Obviously, there has to be financial integrity and consumer and investor protection, and improve the timeliness of regulatory feedback. So those are all challenges, but we would be remiss if we didn't really emphasize the importance. I think we appropriately looked at the international example, and we really look forward to working with the regulators to implement those plans. So in short, we really do believe the United States is a global leader in technology innovation, and that innovation can successfully transfer to the financial services economy, benefiting consumers and businesses. It's a very exciting time to be involved in the financial services policy arena. There's a tremendous energy of behind the nexus of change that I think your industry represents. There's opportunities also for established players to work with you. We have a regulatory system that was designed in and for a different era, and Treasury's report really aims to identify and address that challenge. So I thank you for taking the time to listen today, and I'm glad to answer a few questions before I take off. Thank you.
We got our boxes ready?
Yeah.
Well, I'll take the first question if there's no one. Do we have one? You mentioned the incredible amount of data that's been gathered in a short period of time, and I imagine that's only quantitatively increasing. And yet we read that in China, which is more advanced in some ways in terms of Fintech, and obviously a much larger market, is there any concern at Treasury that we're falling behind Is there any concern at Treasury that we may be falling behind China and perhaps other countries in the data collection world?
We struggle with that in the report because in some ways the U.S. suffers from riches of having such a great financial system and a great capital market. So really, there are some customers that are underserved, but generally there's a huge range of choices for consumer services, financial services from a wide range of venues. And when you contrast that with certain other countries, China being in some ways an emerging market, I mean, it's obviously a very large economy, but in some ways emerging, they actually don't enjoy that. So innovation seems to go quicker because they're launching the first thing, and it's not replacing or competing with something, it's like the first way to do it. So really, if you had a blank piece of paper and you talked about loan applications or how to use data or do credit scores, you would look at it differently than the mature system. So I think in that way, we're at a disadvantage. On the other hand, many of the technology leaders and telecom leaders and whatnot are all U.S. companies, so we have a huge advantage. So I think the key is just to adapt our laws and regulations and modernize them, take advantage of the tremendous incumbent technology advantages we have here and apply them to the financial services sector. They're certainly getting applied to other sectors very effectively, and encourage innovation. So I don't think we're behind. Some jobs may go overseas, but they may go overseas for reasons of cost and other factors. So part of it's also keeping the jobs here, and even if it's a great idea, that there's as little offshoring as possible because we also create the environment for the American worker. But I think we're not really behind. I think in some ways we're ahead, but I think each country is addressing in some ways a different challenge given how the state of the development of their financial system.